Italy became centre of attention earlier this week when we heard that Mr. Berlusconi was going to potentially run for president. Mario Monti announced his resignation, and this disruption to Italian politics following a period of relative calm and stability under Mario Monti's control meant that we did see some quite lively activity in Italian markets on Monday. Start off by looking at the 10-year Italian bond yields, and you can see here that really let's cast our mind back to July, where things were getting obviously very concerning, with yields at 6.5%. But since the announcement of the OMT programme from Mario Draghi, that we've seen yields come down from 6.5 to 4.5%, and it's really these sort of movements in Italian bond yields, Spanish bond yields, that have helped to drive a surge in equity prices during the course of the year. But this blip up that we saw on Friday really just started to reflect some political instability creeping into Italy, and what I sense is over the course of the next maybe 70 days or so, that political sensitivity is going to move European bond yields around at the moment. But as we move towards the end of the week, it feels like some calm has been restored, so I think the statement out from Mario Monti indicating that markets were getting just a little bit too excited about developments, but one to watch, and certainly one to watch quite closely over the course of the Christmas period and New Year. Here we're looking at the Italian stock market, and we see a V shape here during the course of the week. Italian stocks did slump on Monday. We saw a 3% or so fall at the worst for Italian stocks, but they have bounced back and largely recovered those falls from earlier this week. So this chart is interesting. This is the reason why we do need to pay quite close attention through 2013 still to European bond yields. This is what we call the debt distribution model for Italy. Italy has a lot of debt. We can see this number here in the corner, which is a number of the total debt outstanding, and around 16% of that debt, which we can see by this chart here, is due to be refinanced during the course of 2013. Indeed, if we look here at point number 2, we can see the amount that needs refinancing is about 300 billion euros, and also we've got interest of 55 billion euros as well to add on to that. So a lot of debt to be refinanced during the course of next year. And of course, if we do have political stability and lower yields, then this is an issue that will be, I think, sort of slightly removed from market fears. But political instability and shooting up yields in front of that large debt refinancing that's required next year, and of course we could be back to a little bit of a drama in southern European states. So needs watching, but as we exit the week, it looks like calm has been restored for now. And as a result of that, we are seeing equities throughout Europe continuing to nudge towards those highs. FTSE 100 is right on the top of the yearly range. It hasn't managed to breach the 6,000 level on the FTSE 100, but of course in those quieter days over the Christmas period, that could always be a feature and a headline for Christmas. One thing to note is that the FTSE 250 is literally 20 points away or so at the time of filming from breaching an all-time high, which was achieved in 2007. Just moving to some equities of note, we've been talking about Tullow this week, and Tullow has had quite a difficult November and December. Tullow Oil is a FTSE 100 company that had quite a good premium rating for the fact that its exploration success was running at around 75%. But two poor well results have started to reduce the premium that Tullow was trading at. In fairness, it took most of the premium out in one swoop. We can see here that it actually got down to around about £11 a share, which we actually felt at the time was quite an aggressive move to the downside. Things have bounced back, and you can see quite a nice bounce back on that stock. So Tullow Oil is a stock that we do talk about, and we have got research notes on, and one I think to continue to keep an eye on. Currencies, I think, continue to be of interest. Mervyn King was in New York this week, and he continues to fear a currency war. And I think it is worth just highlighting some movements in currencies this week. First of all, the euro is back up towards the sort of top end of the range, and I think this is continuing to reflect some of the sort of easing of the pressures in Europe at the moment. But it also reflects the fact that this week we heard from Ben Bernanke, who has increased his QE programme by an additional $45 billion per month, which is going to be used to acquire treasuries in the market. So they continue to put their foot on the accelerator. They are targeting unemployment as the key measure for when they will keep this accommodative policy going until they see better results. It's on unemployment, 6.5% is the target. And so that weakening of the dollar, strengthening of the euro has taken that back up to the top end of the range. The pound is also interesting. We are hearing first comments coming out from our potential, certainly our new Bank of England governor appointed next week, and George Osborne was questioned under committee that they may move away from the inflation target towards a more growth-based target for their QE type stimulus programme. So again, sterling at the moment holding pretty steadily. Ideally, the Bank of England, I think, would like to see sterling a little bit lower at the moment because, as I mentioned in previous podcasts, there's lost a bit of its competitive edge for some of our export markets. And the other one is to keep an eye on is the Japanese yen. We've seen incredible stimulus help there, and this is ahead of the election at the weekend. Business confidence is down at almost record lows at the moment, and they really do need to get the yen lower to help the competitiveness of exporters, and it seems to be working. This is the US dollar versus the yen, and you can see here how it's really spiked up during October, November and December. So Japan is really going for it at the moment. They really are trying to lower their cost of currency at the moment. It's working for them, but as Mervyn King pointed out, he's worried that it might be others that are going to try a similar trick in the not too distant future. And finally, we're just going to comment on Chinese equities. They've been really the poor performer for this year. I've mentioned before they've underperformed Greece equities during that period of time, but there has been quite a sharp bounce back. We came below 2,000 very temporarily, and we can see there quite a sharp bounce back. Trading up 4% on Friday, but there's a bit of a trend going on in China equities at the moment to the upside.